Hello, everyone, and welcome to today's webinar hosted by TopStepTrader featuring emoji trading. I'm Kevin Adamick of TopStepTrader. If you're not familiar with our site, we fund futures and Forex traders if they pass our two-step evaluation called the Trading Combine. Today, Lee Harris of Emoji Trading is going to provide an overview of order flow concepts and how these can be applied to develop a consistent trading approach that can support passing our trading combine. Lee is a UK-based software developer and trader who has been involved with derivatives trading since the early 1990s. After selling a portion of one of his businesses, Lee devoted full-time attention to trading for a period, taking a desk in a London-based trading arcade plus associated, tuition. Since that time, Lee has focused on trading purely using order flow, developing a very powerful suite of visualization tools based upon supply and demand that really enable, lower stress, less activity, and more consistent trading, based upon the likelihood of market events, using, very tight stops for better risk-reward ratios. With that in mind, I'd like to turn over the microphone to Lee Harris of Emoji Trading.
Thank you very much, Kevin, and welcome everybody. As I say, my name is Lee Harris. I'm from Emoji Trading, and over the next hour or so, we're going to examine how you could really achieve a strong performance in the trading combine with effective order flow visualization. And if you can achieve effective performance in the combine, then you're on a good path to being a solid, profitable, consistent trader, which I think is what we all aspire to. This is going to be recorded. You'll be emailed a link to the recording after the webinar, and you can also ask questions during or at the end of the webinar. I may well batch up the answers at the end, or if, depending on the context, if it's appropriate, I'll answer them as we go along. So, feel free to ask away in the question box. Before we dive into it, I just need to give a short disclaimer, which you've surely heard before many times, and that's futures and Forex trading contain substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle, and only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. So at Emoji Trading, what do we do? Well, I like to think of it that we make it easy to see supply and demand by looking at order flow. We publish a suite of tools for Sierra charts. We've got other platforms in the pipeline. But as you can see from this chart, even without me telling you what's on there, I think you get a sense it's a pretty clear and easy to read chart with some blue boxes and pink boxes. And even if you didn't know the first thing about trading, you showed this to somebody for the first time, they'd have a sense of where good places to go long and good places to go short would be. Order flow is one of those phrases that is thrown around a lot. So let's examine what we really mean by order flow. And I'm going to not answer that first of all by showing this price-based chart. Now, I'm sure many of you started your trading careers with a good understanding of technical analysis, and you pulled up charts like this all the time with candlesticks. We've got some bands on it, probably Bollinger Bands. We've got a MACD histogram underneath. There's some oscillator and RSI. And many traders, especially those coming from a Forex background, will trade based on this kind of chart. The problem with this kind of chart is everything that you're looking at is based on price. If you put volume on this chart, maybe there's a small histogram at the very bottom of the chart, and your mindset, because you've studied volume, is, well, when there's big volume, it's more important. Or you might look at volume divergences. But every other indicator on this chart, the bands, the MACD, the RSI, everything here is derived from price. So we're 2, even 3 steps away from what's actually happening in the market. The candlesticks are showing us the price movement. Every other wiggly line is derived from that price movement. So if we're trying to make a decision, we're relying on a single or a combination of indicators which are derived from the primary price chart, and we're always going to be behind the market. And this is where order flow comes in. So if we're going to define order flow looks at the impact of volume on price. Let me say that again. It's a really important concept. It looks at the impact of volume on price, because price moves because of volume. And we can consider two types of volume: advertised volume and traded volume. I'm going to cover both. What do we mean by advertised volume? Well, I'm sure you're all familiar with what the dome, the depths of market, the price ladder looks like. We've got the scale of prices in the middle. On the left-hand side, we've got the contracts which people are willing to buy if you sell into them. And on the right-hand side, we've got the ask volume. So if you are going to trade at market at the current quote, which is 53 to 53 and a quarter at this example, if you want to buy, if you're going to lift the ask, lift the offer, you're going to pay 53 and a quarter. If you want to sell to somebody who's prepared to buy, and here we've got 1,134 contracts available, then you are going to hit the bid. You're going to sell into one of those 1,134 contracts, and that is the advertised volume. So as we can see at the current quote, sellers are prepared to offer 480 contracts at 53 and a quarter. That is their asking price. Buyers are prepared to purchase 1,134 contracts, and they are bidding a price of 53. And by the way, the reason it's hit the bid, lift the ask, you lift things that go up, price goes up when you buy. If you hit something, it goes down. Hence, you hit the bid, lift the ask. So there's the current quote. But what happens based on volume if a trade occurs? So here, somebody enters an order into market to buy 500 contracts at market. The quote was 53, 53 and a quarter. There were 480 contracts available to be bought. If 500 are bought at market, those 480 that were available to be bought will be consumed, and then the price quote, if those 480 were not replenished, would expand to 53, 53 and a half. And my remaining 20, the 500 minus 480 that were available, will be purchased at 53 and a half, and the available volume to buy will reduce from 347 down to 327. So you can see this is how the trading, the act of buying or selling, moves price. Now, of course, the dome is subject to spoofing. People will pull their orders, people will replenish their iceberg orders, but we can consider advertised volume because the advertised volume will have an impact on the price quote. So as a result of buying and selling occurring, price will move based upon the available liquidity, the available inventory of contracts that can be bought and sold. So that is advertised volume. But let's also think about traded volume. This is a chart style known as a footprint chart. That was a term coined by Market Delta, a guy called Trevor Harnett, who came up with this style of chart. Different software platforms implement this in different ways. It's available in Sierra Chart. They call it numbers bars. There are various third-party offerings for NinjaTrader. Most trading platforms now have some implementation of what is trademarked by Market Delta as a footprint chart. And what this chart does is it shows us the quantity that was traded at the bid and at the ask. So I'm not sure if you can see my pointer here. I'm struggling to confirm that. But if we look at the bar at 926 here, at the very top level, we see 1,213 contracts were traded at market, lifting the offer. 212 were traded, hitting the bid. So the footprint chart shows us the history of what was bought at every price level at the ask and what was sold at the bid. This is what most people consider as trading order flow. So when we have a chart like this, the footprint, what it gives us is the history of transactions that occurred at market by lifting the ask or hitting the bid. And if we recall from the illustration of the dome, price moves because of buying and selling. If we consume the inventory, the quote will move. That's why price moves. Now, there are patterns within the traded volume, within the footprint, the history of the buying and selling, that can provide indications of price levels where there is supply and demand. And that is how we go about trading order flow. You'll notice I'm using the phrase supply and demand. This equates to resistance and support in that order, but it's good to think in terms of the basic economic concepts of supply and demand. Why is this? Well, very simply, if we think about a basic demand curve, which you probably saw in school or in college, at higher prices, there is less demand. At lower prices, there is more demand. The opposite applies for supply. At a high price, many people are prepared to sell. At a low price, not so many people are prepared to sell. Sometimes we struggle with abstracting this into the futures of Forex. So it's good to relate this into real life. Last month in the UK, there was a sale of classic Ferraris 3 or 4 weeks ago. And it was an auction. There was limited supply, potentially many more buyers than the rare cars which are available. And here's a Ferrari Daytona, quite rare, quite expensive, £500,000 was the estimate. And it has a high value because there are not so many around. Let's compare this to mass market cars, Toyotas, Fords, whatever. Here's a Ford dealer. If I'm in the market to go and buy a Ford Focus, I don't expect to have a problem finding one, and I expect to get a discount from the dealer, because not only are there a lot of cars, there are a lot of dealers who are competing for business. There's probably a balance between the supply and demand, whereas by comparison to this rare Ferrari, we have an imbalance. There's only one car available on the market at that auction, and there might be 3 or 4 people ultimately who have a desire to buy it. So if we think in real-world terms of supply and demand, whether it's buying a car, buying a house, bidding on eBay, then that's how we can keep ourselves in tune with the basic premise that at high prices, less people buy, at low prices, less people sell. So with that in mind, what I'm going to explore are some patterns and events that indicate changes in supply and demand. I'm going to show you how we can identify those in footprint charts using order flow, and how we can start to apply this to our trading. Because what we want to do as traders is be on the right side of the market and in tune with the dominant supply or demand. And the 4 concepts which I'm going to go through are exhaustion, absorption, imbalances, and unfinished business. Once I've gone through those concepts, then we're going to take a look at some charts over the past week or so, always easy with the benefit of hindsight, but apply some of these concepts to the trading decisions you could make and see how this could have an effect on the consistency of your trading, whether you're trading on your own account or you've got the goal of how to pass the trading combine. So let's begin with exhaustion. We'll go back to this Ferrari auction. This is very simply the point that when something is up for sale, the higher the price goes, the fewer the buyers there will be. If we're thinking about a classic car being auctioned, the auctioneer is asking, do I hear 300? Yep, 300 bid, 350, thank you, 400, 450. At some point, we're down to the final 2 bidders, one of them drops out. That's exhaustion. The demand is exhausting, running out as price goes higher. So how does this look on a chart? Well, here's a very simple chart. This is a CL chart. It's a 5-minute chart. The blue and the pink boxes are showing us, in the case of the blue, where we are running out of sellers. If we're running out of sellers, then price is unlikely to go down. If price is unlikely to go down, we can be interested in buying. Conversely, at the high prices, we're running out of buyers. And there are some algorithms that allow us as software developers to look at these patterns of exhaustion and highlight them with the pink and blue boxes to make it easy to support your trading decisions. Now, one thing to consider is the pink and blue boxes are happening vertically in the bar, but the bar is arbitrary. It's a 5-minute chart. The market doesn't care about 5 minutes. It could be 15 minutes. It could be a 7-tick point and figure reversal. So as well as us thinking kind of vertically in what's going on in the bar, we can also think horizontally. Now, here at the bottom of the chart, I'm showing what's known as delta. Delta is another important concept in order flow. Delta, very simply, is the difference in the volume that was traded at the ask minus the volume that was traded as the bid. In other words, how much buying less how much selling. If we have positive delta, buying minus selling is positive, we had more buying than selling. If we have negative delta, so buying minus selling is less than 0, by extension, we had more selling than buying. Now, we evaluate delta in different ways, but if we look at the two exhaustion bars towards the right of the chart, with the pink areas at the top, you can see there's a red arrow pointing down, 1040 bar. We had a bar that made a new high, but it experienced exhaustion at the top of the bar at 1035. We were running out of buyers. The next bar went even higher, but the delta went negative. So if I express this in plain English, I could be saying price made a new high, but at the new high, we started to experience fewer buyers. Price again made a new high in the next bar, but at that bar, the amount of selling was higher than the amount of buying. Now, if I say that to you in plain English, and I think it's a really good exercise to look at charts and actually narrate them in terms of simple English and what you can see. If I tell you that twice we've made a new high, we're running out of buyers, and actually we're getting more selling than buying, you probably don't want to buy, and you might even want to think about selling. And that's the basic concept of exhaustion. It's really quite simple. It maybe is not something to initiate a trade upon, but it certainly is something that will let you consider getting out of the trade, or the lack of exhaustion will keep you in a trade if you're already in and it's moving in the right direction. I've illustrated this here on a footprint chart, but the same principle applies just as well on a regular candlestick chart. So here we've got exactly the same chart, a bit more compressed because we don't need the width for the footprint. We've got the same blue boxes and pink boxes indicating the exhaustion, and the red arrows are showing the differences in delta, in other words, buying and selling, which is diverging compared to the price. And I think you can see here, without any curvy lines, Bollinger Bands, MACD, you're already starting to see a story as to how the market is progressing, from which you can start to make some decisions. Let's go on to the next concept, which is absorption. Absorption is an interesting concept. I like to think of it as, how do you visualize what is not happening? Charts show us movements. If we look at the footprint chart, we can see aggressive buying, aggressive selling. But what is really hard to see is the counterparty. Who has got the passive orders, the resting orders, which are being consumed? Let's think about the real world example. Let's imagine that there's a storm warning and you're told that, don't leave your house for the next 5 days. Everybody will go to the supermarket and start stocking up on canned goods and bottled water, which is what we see on the left-hand side. It's rare that a supermarket actually has empty shelves. Normally, a supermarket has got sufficient supply that it is able to absorb however much buying occurs. If this was a regular day in the supermarket, we would expect somebody that works for the supermarket to be coming out and replenishing the shelf. In this case, on the left-hand side, it hasn't happened. So what has occurred here is that while normally the supermarkets would be able to absorb the regular demand, their selling power is bigger than the buying power. What's happened here, the storm warning, is the buyers have absorbed all of the supply. We've got more demand than supply. Now, with that in mind, let's think about what I might do. I might start to speculate on bottled water. I might, the next week, think, you know what, there's going to be a storm again in a month's time. I'm going to buy all the bottled water I can. I'm going to make the market. So I go to the same supermarket who have replenished their shelves, and I start buying all the bottled water. And I go back the next day, and I'm faced with these full shelves. The supermarket has absorbed all my buying. They've replenished. I might try it again and buy all their stock. Their computer doing the replenishments going, oh, we've got lots of demand. Let's supply again. At some point, little old Lee is going to run out of money and not have enough space to store all this bottled water. What's going to happen? Well, I'll think, I need to sell this water and convert it back into money. But I can't compete with the supermarket. I'm going to sell it at a lower price, have a chance of selling it. I puke my position in water. The supermarket was a stronger seller than my buying power. They absorbed my buying. That's absorption. When you equate it to real world, it's quite easy. But on a chart, it can be a bit harder. You're trying to visualize what is not happening. Here's a chart that gives us some indications of absorption. So what we've got here, we've got some blue bars at the lows, We've got some pink bars up at the top. These colored bands are showing us where the passive supply or demand was stronger than the aggressive initiating trades. So at the left-hand side at 834, even though there was strong selling at the low, there was enough resting demand that it ate up all the selling. If all of the selling is absorbed, where will price go? It's not going to go down, therefore we go sideways or we go up. So we should always be on the lookout for absorption at the extremes of price movements. What we can also do, once we're able to identify these supply and demand patterns, is in emoji software, we keep track of these levels, and we use order flow to monitor how these levels react when they're next tested. So we've got an indicator here. We actually call this absorption sequence. What we're doing here is we're seeing if the passive supply and demand continues at the same price level over a number of bars. So we're ignoring the time period of the chart. We're actually aggregating or kind of crunching the charts into a much slower chart. And this helps us think about what's happening at particular price levels, even though we may not see it on the chart. So wherever you see a solid blue line, we've got absorption of selling, it's buying absorption as demand. But when it gets retested, and we can see this at 2704 3/4, the way it was tested, the order flow told us that actually the level held. And we can see that in the 946 bar, that we had demand at 906, we had demand at 909, all at 4 3/4. We went up, we went down within one tick of that level, but it held, we carried on, and then boom, price flew away. So we can visualize and uncover this underlying supply and demand in the market, and we can also track the quality and the progress of the supply and demand as we go through the trading day. And armed with that information, we can start to make better decisions for entries, for stops, and for exits. The third of the four concepts is imbalances. What's an imbalance? Very simply, it's as it says, it's when we have a significant imbalance between supply and demand. Let's think about the Ferrari again. The estimate of the sale price of the Ferrari is between £500,000 and 575k. Imagine the hammer falls and it actually sells for $750,000. Clearly, there was strong demand. We must have had at least two bidders who were fighting with each other that really wanted the car, such that it went for £250,000 more than its estimate. Now, what is likely to happen in a market where we start to see such strong demand? Well, a couple of scenarios can play out. We suddenly might find more of these rare Ferraris are being bought by speculators because they suddenly seem to be worth 50% more than what the experts value them at. So if I have the available funds, maybe I want to buy as many as I can, and I'm going to hoard them thinking that the price will go up. So the demand fuels more demand. Alternatively, everyone who's been sitting on one of these in their garage might actually make it available for sale because the price has become high enough that it attracts more sellers and we increase more supply in the market. And it's an auction process. Every market's an auction process. So an imbalance of demand could result in price going even further as more people buy based on the visibility of this demand, or it could result in more sellers entering to feed the demand. And when we get an imbalance of that supply versus the available demand, guess what will happen? Price will fall. So let's have a look at this in the context of the footprint. Here on the 1105 bar, in the 1105 bar, we have got a stack of buying imbalances. So as you look at the individual bars, you will see red numbers, black numbers, and blue numbers. What we're doing here is we're comparing the diagonal bid and ask quote. And if on this particular chart, if the number of contracts which lifted the ask is more than 400% of those that hit the bid at a given quote, we color it blue. In other words, if 4 times more contracts were bought than sold at any given quote, we go blue. If 4 times more was sold than bought, we go red. So we're treating 400% as our kind of benchmark for what is an imbalance in supply and demand. This can also happen across consecutive price levels, which is what we see in the 1105 bar. Across a range of, 1, 2, 3, 4, 6 prices, every price level across 6 prices was a buying imbalance. We call this a stacked imbalance. So there's clearly a lot of demand. It looks to be about 2,500, 3,000 contracts. So we've highlighted that out. We call this highlight an emoji zone. And we can also track its quality. So when it was retested at 1120, with our view of order flow, that area held, and we can see that the demand was sufficient in the market to prop up the market. So we can see these events as they happen, but it's also very interesting to see what happens when they're retested. So let's have a look at another example where we've got another stacked imbalance. You can see it in the middle of the screen at 2:18 a.m., stupid time to trade. And we've got this stacked imbalance across 3 price levels. Price went up. We experienced exhaustion. We've got 2 pink boxes. We experienced at the highest high where it says divergence, a condition which was, guess what? Divergence. We believe in making it really easy to see what's going on. You can validate that by looking at the delta at the base of the screen. At 240, the delta was lower than where it was at 218. So we get the computer to print divergence. So we're likely to fall back. But look where we fall back. We kind of hit support because there is demand in this solid blue zone. So we trade into it by 1 tick. We bounce up a little, then we break it really strongly. Now, what happens when we break support? It will become resistance. People puke. So we turn that support zone into a resistance zone. It becomes pink. And if we look at that big red bar at 734, not only did we break through the demand, the supply accelerated. We have another stacked imbalance across 5 price levels as the selling accelerated. As we rebound back up again, if we look at the 745 bar, we stop to the tick where the supply is. Now, this is probably just a happy coincidence because we never see this every day on charts. But such is the power of uncovering the supply and demand and visualizing it, enabling us to make our trading decisions. And the beauty of this is we can pinpoint to a price level the areas of interest for our trading. The final concept, which I'm going to go through, is a concept called unfinished business. Now, let's imagine that we're at the Ferrari auction and the auctioneer is going to hear 300 bids, 350, and a fire alarm goes off and we have to evacuate the room. It turned out to be a false alarm. So what happens? We don't all go home. We go back into the building. The auctioneer will restart the auction, maybe at 300, maybe at 250, because we have not run out of demand. The car is still available for sale. There are people in the room who are interested in buying. So the auction at the time that the fire alarm went off was unfinished. The phrase unfinished business and unfinished auction is kind of interchangeable. But the idea here is when we see unfinished business happen in order flow, we're at a price level where if it's at a high, we were not high enough to run out of buyers. If we have not run out of buyers, fire alarm went off, we've gone back into the room, then the market at some point, to satisfy the auction, must revisit that price in order to find the price beyond this level when we do run out of buyers. So what does this look like on our charts? Here's a chart where the orange bands are showing unfinished business. So if we consider the leftmost side of the chart, the 835 and the 840 bars, what we've got here is the open of ES quite recently, 6th of June. Wow, very recent. And what we can see is at 835, we made a new high. And at that time, we can see no volume was sold into the bid. That's because the quotes did not go beyond the high price. But at 840, you see we've got volume on both the bid and the ask side of the bar, this 38,306 at the high of the day. So what this tells us is we got to the high of the day, but that high price, at that high price, we did not run out of buyers. If we'd run out of buyers, then we would have a zero on the bid side. There would have been no passive buying. But because there's no zero, we did not run out of buyers. If we did not run out of buyers, then it's likely that the auction process within every market is going to want to revisit that price to see if we do run out of buyers when we next go there. And sure enough, we can see as we move through the day, we revisit what was the high of the day. What you can also see is that 844 bar, the new low, we had unfinished business again. Price was not low enough that we ran out of sellers. And very quickly, within 2 bars, we revisited it. And unfinished business is really one of my favorite concepts in trading because it can really give us some clues as to where price may go. And my take on this is, if we know a target before we have an entry, we're in a really good position to evaluate a good potential trade because we can constantly evaluate our potential risk reward. Many traders will see an entry signal, whether it's a delta divergence or a buying imbalance or maybe absorption or maybe a MACD or phase of the moon if you use Trader 8. And they will enter and go, okay, my stop is 5 ticks, my target is 10 ticks. The market doesn't care about those 5 ticks or 10 ticks. The market cares about supply and demand. With unfinished business, we already know a price which has shown us that we have not run out of buyers or we have not run out of sellers. We also know that the market auctions up and down to find where we do run out of buyers and run out of sellers. So if we have a potential target, we can now have a bias and we can be looking for an entry which gives us a favorable risk-reward ratio in order to exploit the target. And that really, I think, is one of the fundamental approaches to trading consistently with low risk, whether it's your own account or as a measured way of passing an evaluation like the TopStep Combine. So I've given a really quick overview here of some of the order flow concepts. What are the next steps to start to apply order flow to your trading? Well, first step, let's go of price-based indicators. We've had a quick walkthrough of 4 concepts. Let's go back to this chart. I would ask you whether you regard this as clearer as some of the charts which we've seen over the past 15, 20 minutes. I look at this, and okay, I've studied technical analysis a lot, but if I was to trade off this because I was trading Forex or, I don't know, spread betting or this kind of thing, I would not feel comfortable because I'm not getting the full picture. So step 1 is, you know what, have the faith, get rid of all this technical analysis, lagging price-based indicators. You do not use this to make your primary trading decisions. Read the story that the market has to tell you. Here is one of the charts we saw earlier, and just very simply learn to look at a chart and express in plain English what is happening. Price made a new high at 10:35 in the morning, but we got fewer and fewer buyers as prices went up. In the next bar, price went even further up. Once again, at the higher prices, there were fewer buyers, but actually the amount of selling, the delta, was higher than the amount of buying. So in summary, we made a new high, demand was falling off, and we got more selling pressure than buying pressure. When you are able to narrate the market story in this way, you are able to make some well-informed, low-risk trading decisions and actually avoid overtrading. Next step, don't prejudge the arbitrary levels that everyone in the market can see. Let the market tell you what to do with them. So what I mean here are the horizontal lines that we draw on charts. You'll notice that the examples I've given, we have just got the regular trading hours, high and low. I just want to see where I am in the day. I haven't got a POC, I haven't got a VWAP, I don't have pivot points, which we see here. All I want is a sense of, am I high or low for the day? Pivot points make a lot of sense. If you're a pit trader 10, 15 years ago, armed with a notepad, then pivot points were great because you could look at yesterday's range and close. You could do some very simple calculations with your notepad and pencil, and you'd have an idea of range and potential pivots for the day. But in and of themselves, they're meaningless. They only have power as to Fibonacci's or this kind of thing because lots of people are looking at them. Now, just because lots of people are looking at them isn't a reason for us to base our trading decisions off them. What we're interested in is how does the market react at the levels where lots of people are actually trading. Here, I've overlaid some exhaustion indicators on this chart. We've got the pink and the blue boxes. Look at how they coincide with the pivot points. Now, it's kind of what's leading what? Are we getting exhaustion because people are selling at the pivot points? Or are the pivot points creating exhaustion? It's kind of one and the same. But the point is we don't need these arbitrary horizontal lines on the chart in order to assess what's going on. The risk of having these arbitrary levels is we will prejudge our decisions because there's a line here, we're probably going to go to it. If we remove these arbitrary signals from the chart and we allow the market to tell us what is happening, is there absorption, is there exhaustion, is there unfinished business, we keep our brains free of distraction. Now, this webinar is being hosted by TopStepTrader, of whom we're strong advocates at emoji trading. And I now want to think about how do you apply order flow and what are your next steps for being successful in TopStep Combine? And it's the same thing for being successful in your own trading. Most importantly, preserve capital. The smallest TopStep Combine allows you a $500 daily loss limit, which in my view is a fortune. I trade with a $250 hard daily loss limit. If I hit $250, my platform locks out trading the rest of the day. Seriously, highlighted in green. The key to survival in trading is limiting your losses. I start the day trading small. I will trade one contract. As I scale up and I build P&L, I will add to my contracts. But the point is we do not want to risk burning our equity. We want to stay in the game. You also need to apply maths to passing the combine. And I'll show you now from some examples that our patience is rewarded. Patience and our own self-discipline is one of the hardest things to crack. And no end of presentations, whatever, can really help you on this. It's up to you to learn that patience and discipline. But if I think about the smallest $30,000 combine accounts, you must trade a minimum of 5 days. You must make $2,000 minimum. That can be challenging. I think it's realistic off one lot to, as a beginner, consistently make $150, $200 a day. But you start to apply some maths to how you will pass this and build a trading strategy. You can think, well, if I have a 60% win rate and I know I have to make $2,000 and my daily loss limit is $250, you can start to plan the number of days and what your profitability has to be each day. Nobody can trade at 100% win rate. And what I like to tell some of my students who, everybody suffers from fear of missing out. We all jump in too early because we're going to miss this opportunity to make money. We don't miss opportunities to make money. We miss opportunities to actually lose money on losing trades. If we miss a trade, it doesn't matter. We have missed an opportunity to lose money. So we must have the mindset of preservation of capital and trading with very low risk and the best entries. So if we apply simple order flow based setups to frequent day trading occurrences, it gives us the best chance of doing this. Last week, Kevin ran a webinar that was introducing the Combine. He said the most successful traders at TopStepTrader trade 2, maybe 3 times per day per contract. And what we're looking for here are the consistent setups that happen in the market every day. And what happens every day in the market? The market opens, it makes a range during the first hour. In market profile terms, the initial balance. It on most days will break that range on one side, maybe both sides. There are various statistics and studies on the internet that go through the likelihoods of each instrument and which sides will be broken. It traverses further on in some direction. Occasionally it's a trends day and it only moves in one direction. But more frequently, after we've broken the initial balance range, we reach a level, high of the day or low of the day, and we fall back in. So what we really want to do is be able to trade the inside-out trade. So what was the break of the initial balance? But we don't want to trade the breakout. We want to have a sense of which side will break and can we be ahead of that break in order to trade it. Then, depending upon how long we've been able to ride that trade, we want the reversion trade, the outside in. So with order flow, we give ourselves a reasonably good chance of being able to identify both the inside out and the outside in trades. If we can do those consistently on 1, 2 contracts, 1 or 2 products each day, we have a chance of making a living as a professional trader. What I've now got are some examples. I pulled these off at the weekend, so I've got various days that occurred over the past week. I've also highlighted yesterday and today. And we'll just have a quick walkthrough as to how some of these principles could have been applied in the market. And you know what? It's always easy in hindsight to do this. But I want to make the point that if you are slow, if you are patient, if you are very pure on applying principles of order flow, you have a good chance of being able to spot some high probability, low risk setups and have a chance of some nice, clean, low stress trading. So here's an example of an inside out trade. This is ES from the 7th of June, which would be last Thursday. What we can see here as we look along the chart at 9:29, closing time of that bar is 9:29 and 52 seconds, just inside the first hour. We made the low of the day, but you can see from the orange highlight, we did not run out of sellers. We experienced unfinished business at the low of the day. We did not break the initial balance low. That bar closed inside the first hour. So at 9:29.52, we can have a sense that, okay, ES made a low of the day, but price was not low enough in order for us to run out of sellers. And at this point, we start thinking, okay, I'm very interested in getting a short trade and look for a short entry. Above us, between 75 and 76, we have some aggressive selling that occurred, and we're extending the zone outwards. So we know there's historic supply at that level. The first arrow indicates that. What we can see when we traded back into that zone at 10:09, we had a selling imbalance at 1,170 contracts just within that zone. That would have been quite an aggressive entry. So as well as having a bias, in order for us to have a good trade, we've got this bias, we've got the target, the unfinished business. We're then really looking for a price area where we could make our entry, but we're also looking for a trigger. And a simple trigger we could look at is actually, we want to only enter when we see a selling imbalance. So those 1,170 contracts sold, it was way more than the 218 on the other side of the quote. That could have been a good trigger. We'd been conservative. We might have set a sell stop a couple of ticks below in order to enter. But that would have given us an entry around 75.25. We would know if that selling imbalance disappeared 2 ticks away, we were wrong. Certainly, if we traded above 76, we'd be wrong. So we had a point at risk, but our target was what, 66? We were almost 9-10 points away. So an incredibly favorable risk-reward ratio. That would have been an aggressive entry. We could have waited for that bar to close, see what happened, and thought, you know what, I'm going to enter on the next selling imbalance. And actually, I'm going to enter 2 ticks underneath. And that's highlighted price level of the green horizontal arrow. So that was 73.75. Now, an entry there, we'd have been in this trade quite a while. You know, this maybe feels a bit more like swing trading. We're certainly not scalping. But again, we've got super low risk. We've got 1 point of risk, $50, versus the target that's 8 points away. And our maximum adverse excursion, had we entered at 73.75, was 2 ticks. So quite low stress. But this is all about patience. There was a 40-minute period between the target emerging and our first possible entry. The trade took, let's see, it took about 90 minutes to play out. But one trade, $400. This is against the combine target, maybe $2,000. That is actually quite a low stress way to trade. Let's take a look at another example on another day. I like to think of this as an outside-in trade. As I recall, this is the 5th. This was last Tuesday. Bit of an odd day. What we have here, again, 9:29.36. We've got unfinished business at the high of the day on ES. We've got a target. We're looking for a reason to go long. So on the way down, 10:24, we've got some divergence. So we made a lower low, but there was less selling. We may be looking for a buying imbalance, but as we look in 10:36 bar, 10:40 bar, there are actually no buying imbalances. Not till 10:49 did we get the first one. We could have entered there. We'd have probably been stopped out. We'd have been stopped out by about a point. We certainly wouldn't want to take the heat back down to low. But what's interesting, at 11:03, not only do we get another divergence, we've also got absorption. So the passive buying was way more powerful than the selling. So now we've kind of got two order flow conditions happening. As well as us meeting the low of the day, but with much less selling power, we also have strong passive buying occurring. This is at what, 27.39? And we know that at 27.52.5, we have not run out of buyers. This starts to get interesting. So if we now feel, okay, I've had two supply and demand events, which have kind of made me pull the hammer back. Now I'm looking for a reason to pull the trigger. The reason for pulling the trigger is going to be a buying imbalance, which we get in the next bar at 11:06. And we can see, let me just try and highlight it here for you. There we go. We can see the 75 and the 738 buying imbalance in that bar. So maybe we would have entered a buy stock a level above when we saw the 75 imbalance. So we'd have got in around 41.75. How did things play out? Let's have a look. So I've highlighted this entry. Let me just erase that drawing. Okay. So the green arrow indicates 2 ticks above the buying imbalance on the entry bar at 11:06. We hit the unfinished business. It took a long time, and it was almost the end of the day. We traveled a hell of a long way. We traveled almost 11 points. We were carrying through this bar 1.5 points risk. So on one contract, what, $75? We would have been offside by 5 ticks, which is not really that stressful. If we had had the patience to see this trade through, we would have got our 52.5 for $537.5. Always easy in hindsight, but you get the point. This very measured, very patient approach respecting supply and demand can be a good, consistent way to trade, certainly on an assessment method like the Combine. Let's take a look at another example from the past week. Okay, here's outside in. So the idea here is that the extremes of the day are too far, we want to fade. What we've got here, and as I recall, let's see, this is ES on the 4th. This is last Monday, so not yesterday, Monday of last week. As I recall, this day we didn't actually break either side of the range. But what we can see here, 8:53, we satisfy the unfinished business, we have a divergence, and we have exhaustion. We can see selling imbalances in the next bar. We've got a similar thing as we get to the low. We've got absorption, we've got a divergence, all at 10:23. We have a buying imbalance. Let's just try to highlight it. But even on a very kind of directionless day, if we trade like a prop trader, which is what we all aspire to be, and we fade the edges, the supply and demand, combined with our triggers, the imbalances, can give us quite low risk ways in order to take some profits out of the market. Here, if we'd entered at what, 48, there's probably around 6 points available until we probably would have been stopped out by trailing stop, maybe here. Here, similarly, we may have treated the divergence as a reason to get out. But when we look at the adverse excursion for either of these trades, these are so low stress and low risk that they're great opportunities. Now, the only way, of course, that you can actually feel comfortable with these kinds of trades is by observing the supply and demand and having the faith, because at the hard right edge of the chart, who knows what's going on? When you see enough of these exhaustion and absorption occurrences in real life at the hard right edge, combined with tight stops, then you have the faith to be consistent and go in with them. Here's a CL chart. I know many traders on the Combine like trading CL. There's only one news release per week, which is great. We've got an inside-out trade and an outside-in trade. You can see here, you're probably getting better than me at this now, 10.29 before the, sorry, that's, of course, this is after the break of the initial balance, but we made a new low of the day. We have unfinished business. You can see the orange line. We're looking for an entry. Well, we've got exhaustion, we've got a selling imbalance, we've got a target, and the risk reward, which we're looking at, here's our risk with what, 4, 5 ticks, 6 ticks, my analysis. If we entered on this imbalance, we never went offside. We could have trailed our stop down from the high of each bar, exited here, 24 ticks. Here we have an outside in trade. Because we had unfinished business here at the low of the day, we would not want to revert. We'd want to trade towards it. But here at the low of the day, we can see that we made a low with exhaustion. We made another low with a divergence. Now we're looking for our trigger. There's our buying imbalance. We could enter with a buy stop 2 ticks above. Even if we had trailed our stop on the low of the bar, this would have been our exit at around 65.05 from an entry at 75. So easily 20 ticks, probably 30 ticks, carrying maybe 4 ticks risk on this bar. I think I have one more example over the past week. Let's just clear these drawings here. Here we go. Another outside in trade on CL. Okay, we can see here there was a historic unfinished business from somewhere, which guess what? This got hit. We made a high of the day. Here's a new high. We've got our exhaustion. We've got a divergence. Here's our trigger, selling imbalance. Let's enter 2 ticks below. Here's our entry at what, 98, this kind of level. I haven't actually charted the exit on here. We have never been offside, 0 ticks, adverse excursion. We have got a stacked selling imbalance here, so supply has increased. Realistically, at the point we saw this, we'd have taken our trailing stop somewhere here, so around 65, 78, this kind of level. So we have at least 20 ticks available to us here, 200 bucks. So there are 5 real days, and you know, I will contend these things are always easy in hindsight. It's only an experience. You get the confidence to pull the trigger as it's playing out in real time. But on 1 or 2 trades per day on each product, what was achievable there was about $2,100. Now, that's trading one lot with very, very favorable offside moves. So maybe I just got lucky on finding these amazing examples last week. Well, here's a chart which I printed out and put in the presentation from yesterday. Here's ES from yesterday, and I've called this patience is rewarded. This week, I think because the Trump North Korea thing has been quite a twitchy, strange week. But we can see here that although we couldn't get a bias on the inside out trade, after we broke the initial balance, we went up with some unfinished business, we went up again, okay, exhaustion and a divergence, but no selling imbalance trigger, no reason for us to sell here. We've got another thing here, we've got some absorption, 1 tick below the high, here's our selling imbalance. That gives us a nice entry. We have at this swing low an unfinished business. This entry to this swing low is 35 ticks versus 4 ticks risk. So Monday on ES, if we were patient, and it took a long time to play out, and look when we actually got there. But entering at lunchtime, horrible time to trade. Leaving it to the end of the day, 35 ticks. And I traded a little bit this morning on ES. I pulled a chart out here. Today was very strange. We had a bill auction. We had the market trying to understand what on earth is going on with Trump and Korea, etc. But someone asked me the times of my chart. The ES charts are all central time. I run my charts on exchange time. So what we have here is ES made its high of the day. This bar took an age to play out this morning. It really crept up slowly. Exhaustion on its own, for me, not really enough of a reason to get in, but it was such a slow grind up. Even on a horrible churny day like today, we get our selling imbalance trigger, we made our way down, we have our selling here. There's 3 to 4 points to be made today. So what I've kind of shown here is that if you are patient, if you take some faith that supply and demand actually has something in it, then you do have the opportunity to develop as a low-risk, consistent, reasonably profitable trader. And that is the way in which to pass the TopStep Combine. So in terms of the TopStep Combine, I'm going to reiterate, preserve your capital. You can have a very small daily loss limit because we are trading with 4 ticks, 5 ticks of risk. On ES, we're risking $50 a trade. So you don't need to lose $500 a day. If you lose 200, you've got 4 trades wrong in a row, you stop. You can trade small one contracts, and you can consistently achieve 200, 300, 400 bucks off one lot trades. As you become more skilled, and you can trade other order flow concepts like zero prints, like thin spots, you can start to trade within your trade, scalp in the direction that you're going, and work your trade harder. But even trading one lot with a small, hard daily loss limit, you can achieve 2,000 bucks in 5 days. Let me ask you again, do you want to make your trading decisions on a laggy chart like this that isn't telling you what's going on? For me, I can't trade like this anymore. For this, I feel blind. I might as well play roulette. Once you see the supply and demand, then for me, I really don't think there's any other way to trade. Now, we've had a few questions which stacked up. I'll go through those in a minute. But as my final chart and kind of the logical next steps, I would say get equipped and get disciplined. Firstly, learn the concepts of order flow and supply and demand and gain trust in reading the supply and demand and watching it play out. We can help you do that. We've got a YouTube channel at youtube.com/emoji trading, where at the moment I think we've got 7 or 8 videos on there. We add a few every few months. And it introduces concepts of order flow. We bring some of them to life using some of our indicators, using Sierra chart. But you can learn in simple language, hopefully like I've given you today, how to apply supply and demand to your trading. The next step, invest in a charting platform that has a footprint. I'm an advocate of Sierra chart. That's what we publish our indicators into. We are working this year to port to other platforms, including NinjaTrader. But unless you can really see the supply and demand that's going on, it's very hard to make those decisions. Step 3, make your life easy. And I'm able to read the footprint chart, read the business numbers and get what's going on. I find it much easier if the computer draws a blue box or a pink box or says divergence. If it says that to me, my brain is free to make other decisions. So you can use visualizations such as those which we publish at Emoji Trading to make your life easier reading supply and demand. If you're interested in our suite of tools, you can sign up at www.emojitrading.com/trial. We can also help you get set up with a 30-day trial of Sierra chart, complete with live CME data. We offer a 30-day free trial on our indicators, and we offer various monthly, 3-monthly, and lifetime licensing options on any or all of the indicators. What I'm going to do now is go through some of the questions and let's see what we can. So will we make a recording available? Yep, absolutely. Details of the recording are going to be emailed out after this webinar is finished. Bob is asking, is it more important to use diagonal delta to determine supply and demand versus delta at each price? That's a really informed question, Bob. So if we are looking at the supply and demand given price level to assess something like absorption, we don't use diagonal. Diagonal represents the quote. What we want to do at a given price, 27.29 we will look at the horizontal delta in order to assess the delta that occurred at that price level. We're taking into account when that price was the bid and when it was the ask. So we determine horizontal, we determine the horizontal delta at every price level to understand where that price level is. Hopefully that makes sense. Russ is asking, what charts am I using in this webinar and how can we get them? Well, these are from Sierra Chart using the Emoji Trading Order Flow Suite visualizations. They are ES and CL predominantly. They'll be in the recording of the webinar. If you sign up to a trial or subscribe to our tools, and we've got various preset chart books and indicators that help you get going on a quick start. Jean or Jean Dominique is asking, are you able to spot the outside in and inside out on the E-mini? Well, I do my best. And hopefully you've seen from some of those examples that the way in which I go about doing it. Certainly for the inside out, I'm much happier if there's an unfinished business, give me a bias or some other strong clue. For the outside in, I'm looking at exhaustion, maybe absorption. I'm really looking for my trigger. Anita is asking, 1106 bar unfinished business, is this a reason not to trade? Let's take that one offline, Anita. I think drop us an email at info@emojitrading.com. We'll refer back to the example and we can go through specific setups. Guido is asking, how often unfinished auction early in the day are not going to be covered within the same day? I can't answer that numerically. I have seen enough instances of unfinished business at significant highs and lows, which for me is a high of the session, low of the session, get resolved during the day that I'm comfortable treating that as a setup. Swing highs and lows can be a bit more subjective. Sometimes the market will tease us and we get within one tick. This is something to explore and get a sense of the day types. You know, tomorrow's FOMC, today consequently was quite range bound and twitchy. It's something to learn and absorb. I'm not going to say that 67% of the time they will resolve. You will get the sense of this with screen time, but it is, in my experience, quite a reliable setup. Michael is confirming, so in essence, you look for exhaustion and use the imbalance as the entry signal trigger. Yeah, I'm looking for exhaustion or absorption as the reason I like to think of it as cocking the hammer on the gun, but imbalance or some other trigger, sometimes I look at liquidity, there are various things which I look at, but for simple examples, exhaustion or delta divergence on its own is not enough reason for me to initiate the trade. If I have a target, if I then have a supply and demand event like exhaustion, I'm then looking for a reason to pull the trigger, which can be something like the first imbalance that's in direction in my favor. Nitra is asking, selling or buying imbalance, how do you know they last? I mean, frequently price moves up and down. Indeed, they do. And this is why one of my preferred ways of entering, if I use the imbalance as a trigger, is to enter through a stop beyond so that I get taken into the trade with the movement of price. Certainly the supply and demand event like exhaustion, I wouldn't trade that intrabar. For me, it's the early warning. But I'm prepared to be wrong on the trigger, but I'm also prepared to get out within 2 or 3 ticks if the imbalance disappears. The buying and selling imbalances you mentioned are easy to see in hindsight, but they appear all the time during the day and they get covered up with subsequent trading. If we use a 30-minute footprint, we can be a mile from the imbalance before we know it's solid. Well, I think if you're a mile from the imbalance, you've missed your opportunity. As I mentioned earlier, my approach would be the imbalance is the trigger, but maybe get in 1 or 2 ticks less favorably than the imbalance. If the imbalance disappears, get out. You've burnt 2 ticks, 3 ticks. You can have multiple bites of the cherry at getting in. Waiting for the bar to close to confirm that imbalance is likely to be too late. But intra-bar, once we've got a target, once we've got a supply and demand event, then we can feel relatively confident about our trigger. And if we burn 2 or 3 ticks, then that's the nature of the business we're in. But it's better than letting it swing away and burning 10 ticks. Guido says thanks. Well, thank you, Guido. YouTube says emoji trading has no content. I don't buy that. The Koreans have got to me. Certainly youtube.com/emoji trading. If you click on the videos tab, you will see all our videos. Michael is commenting on videos. Is our trial free? Absolutely. You can sign up for a free 30-day trial of our order flow suite. You will need Sierra Chart. We can help you get a free trial of that as well. We do take payment information. What you're doing is you're signing up to a 3-month subscription of our tools, but this begins with a 30-day free trial, which you can cancel at any time through the My Account link on our website. And we do not make any charge to your payment card whatsoever during the free trial period. It's only when you leave the free trial period, if you haven't cancelled, that we roll you into a paid subscription. Are we using tick-based charts or volume or time on the footprints? I use a reversal chart, so point and figure style. On ES, I tend to use a 7-tick reversal chart. I'm not a fan of time-based charts, not for intraday. I like them for context. I'll look at a daily chart. For long-term, maybe an hourly chart. But I want to see the progression of ups and downs and get a sense of flow in the market. So for me, a reversal chart is the way to go. When do we expect Ports and Ninja? Some point this year. But we're big fans of Sierra Chart as well. And I would say that it's not a reason to wait. Sierra Chart is very good. Michael makes my second point that your webinar has given us the importance to hold for targets. Absolutely. An order flow can give us the confidence to stay in a trade longer than we may otherwise do that. Do we wait for the imbalance to show immediately when the candle closes? No, as I mentioned, we will, for the trigger, we'll wait for it to show, but then get in a little bit further away. Any chance of us getting on Tradeovate? It's not top of the list for our horizontal expansion, but it is on the list. Let's put it that way. And that's the questions. So once again, for your next steps, you can visit our YouTube channel, youtube.com/emoji trading. And if you're interested in learning more and you'd like to have a play and experiment with some of our indicators, visit us at emojitrading.com/trial. Thank you very much indeed for your attention, and cheers.